Hi, I'm Kylie Matu and welcome to Wealthy Millionaire. Today we're going to talk about the similarities and the difference between stocks and bonds. But first, this is for educational purposes only, so make sure to always consult with a professional before making any financial decisions. You may have heard people refer to stocks and bonds when they're talking about their retirement accounts or personal investments. These two products make up the majority of investing. So let's take a look at how they work. So what is a stock? Well, it's a piece of equity. It's a product that you purchase that represents partial ownership into a company. So companies sell or issue shares on the stock market for public to buy, and each share represents one small portion of the company. If the company does well, then the stock value will go up. And this means that the people who bought the shares, also known as shareholders, gain profit. And if the company does poorly, then the stock value will go down. And this means that the shareholders will take a loss. The stock market allows companies to raise money in exchange for partial ownership of their business. Everyone who buys the shares is considered an investor. The money you put into purchasing the share then goes to the company, and the company uses it to run their business. Then we have bonds. These are a product that represent a loan. It's like an I.O.U. that represents debt from the lender to the borrower, which must eventually be repaid with interest. The basic idea is that a bond is a piece of paper that represents borrowed money. Each bond contains the details of how much money is borrowed, how much is owed, and when the payments are made, and the maturity date for when the bond is used to be paid back in full. Governments and corporations will sell or issue bonds to raise money much like stocks. The original purpose of bonds was to raise money for war. However, they're used to build roads, schools, water, infrastructure, electrical grids, football stadiums, and all sorts of important projects that require large amounts of money. For example, consider a government issue war bonds for $100 at 5% interest with a 5-year maturity date. A citizen can spend $100 to support their country, and in return, they'll be paid $105 when the bond matures in 5 years. This sum is typically paid in installments every 6 months. Bonds offer lagging and leading indicators in the stock market. So a bearish stock market leads to divestment into bonds, and a bearish bond market leads into the growth of stock indices. In this way, bonds can be used to foresee changes in equity. So how can we use these stocks and bonds to grow your money? Before you buy stocks and bonds, there are a few things you should first understand. Profitable gains versus earning interest. Owning stock gives you a chance to profit from increasing prices in shares. If you sell the shares for a greater price than you bought them for, then you make a profit. In other words, buy low, sell high. A stock investor wants to invest in healthy companies with promising futures. The money you make in stocks from buying and selling is considered capital gains, and these are taxed differently than a wage or salary. Owning bonds gives you the chance to profit from interest, like any other type of loan you're making, or a profit from the interest or lending out your money. As opposed to buying stocks, your income from bonds is interest rather than capital gains. Depending on your regional laws and where you purchase the bonds, the money you make from owning bonds is often non-taxable. This primarily applies to government bonds. One goes up and the other goes down. In financial markets, everything is connected, directly or indirectly, as stocks and bonds are two of the most popular markets worldwide. They have an important relationship. When the stock market goes down, like in a huge market crash, investors will panic and sell their shares. Then they will invest their money into other markets, most often the bond market. So when stocks go down, bonds go up. When the stock market is doing well, such as directly after a market crash, investors will put more of their money into the stock market. This means fewer purchases are being made in the bond market. So when stocks go up, bonds go down. There are also some risks to consider. Each market has its own set of risks. However, in general, bonds are safer and stocks are riskier. Bonds provide a stable income from the interest in your loans. While bond rates seem low at first, they can be reinvested and compounded over time. Ultimately, bonds provide a stable and reliable source of income with your savings. Bonds are generally more stable than stocks in the short term, but this lower risk typically translates to lower returns. Treasury securities such as government bonds and bills are virtually risk-free, as these instruments are backed by the U.S. government. Corporate bonds, on the other hand, have widely varying levels of risk and return. If a company has a higher likelihood of going bankrupt and is therefore unable to continue paying interest, its bonds will be considered much riskier than those of a company with a very low chance of going bankrupt. A company's ability to pay back debt is usually reflected on its credit rating. Stocks provide riskier gains from the growth of your investments. Some stocks are riskier than others, but they can provide much higher returns than bonds in general. Investing wisely in the right stocks can multiply your savings. In investing, higher rewards mean higher risk. And if any company's performance doesn't live up to the investor's expectations, its stock prices could fall. Given numerous reasons a company's business could decline, stocks are typically riskier than bonds. However, with that higher risk can come higher returns. As of June 11, 2020, the S&P 500 has a 10-year average annual return of 10.65%, while the U.S. bond market has a 10-year total return of 3.92%. So how can you diversify and get the best out of both worlds? Now you may be thinking, why not buy both? That's actually a very good idea. One way to reduce the overall risk of your investments is to spread your money across several assets and markets. This is called diversification. In other words, you don't need to put all your eggs in one basket. Even within your stock and bond investments, you want to diversify your stocks and diversify your bonds. So if one company or one type of bond does not perform well, the other investments can make up for it. For many, investing for retirement is good preparation. The older you are, the more you want to put into your safer investments like bonds. That way, the bulk of your money is safe as you get close to retirement age. Having more money in stocks at a young age will build wealth. The rule of thumb here is to subtract your age from 120 and use that number to determine the percentage of your portfolio that should be used in stocks. So a 30-year-old would have 90% of their portfolio in stocks and 10% in bonds. However, this rule of thumb can be adjusted depending on your risk tolerance and the performance of the bond market. The rules of thumb provide simple answers to investing, but the market is anything but simple. Are there special approaches to stocks and bonds? This is a whole world of exciting investments in the financial market. Many are just below the surface of what the average investor considers. Let's take a look at a few special types of investments that provide unique benefits. First, we have trading bonds. Instead of waiting to collect interest after the maturity date, you can sell bonds at a higher price than what you purchased them for. The price will go up if the interest rates go down or if the risk profile of the issuer improves. However, the retail investor has limited access to this activity. Not all bond activity is as low risk and stable as it may seem. Bonds are often very large investments, and people who trade them can collect very large commissions. Compared to just buying bonds for retirement, trading them can be very exciting. This is a way to make a faster profit rather than a steady income. Next, we have dividend stocks. On the other hand, dividend stocks provide a way for investors to make a steady income on stocks as opposed to faster and riskier profits. A dividend stock will regularly pay out dividends, which are a portion of the stock price that is paid in cash to shareholders. For example, a dividend stock worth $10 may pay out 5 cents in dividends each period. That means for every $10 stock that you own, you'll make 5 cents or 5% when dividends are paid out. This is a way for larger companies, which are not as focused on growth as younger companies, but to attract shareholders. Some of these actually pay out every month, providing a very steady income that could even replace a monthly salary or wage. Then we have a preferred stock. So this is a type of dividend stock that is prioritized or preferred by the issuer. These stocks pay out higher dividends and are a higher priority for the companies that issue them. In a way, preferred stocks are a combination of stocks and bonds. Like stocks, preferred stocks represent equity. However, much like bonds, they offer a steady income from investments. These are the best stocks to purchase if you want to sacrifice things like voting rights in the company in exchange for increased dividend payouts. What is the difference between a baby bond and a preferred stock? Well, a baby bond is simply a bond with a value below $1,000. These bonds will still pay a fixed income for ownership, but they are more accessible to retail investors like dividend stock. As you can see, there's a lot of differences between stocks and bonds. I hope this information helped you in your decision making when investing. Again, please make sure to always reach out to a professional before making any decisions. I'm Kylie Mathieu. Thank you for watching Wealthy Millionaire.